Okay, hello. Can you all hear me? If anyone down here can put a chat whether they can hear me or not. Because from what I see here, everything looks fine, but I'm not sure whether it works. Okay, I will start the session exactly 8:30. As you all can see, I'm doing a portfolio review and also sharing with you all my 2024 financial goals. Okay, can you all see? Let me know in the chat if you all are able to see. So as I know that it's online. Okay, I think I'm online because I'm seeing from the screen that I got one concurrent view. I guess I'm online. Okay, can. Thank you so much. Okay, I will start the session at 8:30. So we still got 1 minute thereabouts. Okay, as you can see, I'm doing a portfolio review and also sharing my 2024 financial goals. Okay, so I will share so before I start, let me just give some disclaimer first. It's my first time doing this, and so do expect some hiccups here and there. I also got some anxiety issues with regards to stage fright and whatnots. And speaking wise, I might speak a little fast, so I'll try to slow down if possible. Okay, so yeah, and also whatever discussed in this live is not financial advice. So let's take it as a sharing session. Okay, so I'll show you all my investment portfolio. As of today, 5:20 p.m., it already stands at around 220,000. Okay, this one is in Sing dollars. So in the whole portfolio, there is both US stocks and also Singapore stocks and REITs. And in total, I only own 7 counters. So 3 stocks and 4 REITs. And then dividends received for 2023 is around 5.5 thousand. So yeah, so everything together, the returns for 2023 is about 23,000. Okay, so now I'll go through the individual stocks and REITs that I have in my portfolio. Okay, so as I said before, I got 7 counters in total, and then these counters end up contribute to around 35% of my total cash net worth. Okay, so the remaining 25% is mainly my cash, basically cash in savings accounts, in cash management accounts, and whatnots. Yeah, so the rest of it is all in these 7 counters you see here. Okay, so let's start with my biggest investment counter first, which is Tesla. Okay, so Tesla contributes around 29.5% of my total investment portfolio. Okay, I invested in it since 2021, and then total returns till date, based on capital returns alone, is 29.17%. So close to about the 29%. And then average cost per share is currently at about $884.20. And then I hold about 208 shares of Tesla. Okay, as of now, I plan to actually reduce this amount to maybe about 150. But then, based on market conditions wise, I don't think it's the right time to sell Tesla as of now, lah, because it's not in a very good market price as of now. Okay, so I'm not sure what Tesla is all about, right? They have two main revenue segments: automotive and energy generation and storage. So automotive is like EVs, which is most commonly what people know or identify Tesla as an EV company. Okay, so for EVs wise, revenue will contribute around 93.6% as of 9-month FY23. So you can say that majority of the revenue comes from their EV production. So EVs also constitutes their charging networks and also FSD, which is full self-driving, which is the autopilot feature. So, but as of 2023, most of it comes from the selling of EVs, not so much from the supercharger networks or the FSD, although they do contribute quite a significant amount. If you look at Tesla financial statements, right? Let me just bring it up for you all. Okay, you can see that based on 2022, which was last year, automotive contributes 84.7%. Sorry, automotive contributes 87.7%, of which leasing contributes 3%, and then your FSD, right, is 7.5%. So if you add up both together of 87.7% and 7.5%, you'll get a total number of close to about 90% plus. So yeah, so you can see that FSD wise, their contribution to the revenue has been increasing year on year, from 468 million to 6 billion as of 2022. So I expect this more to increase for 2023. Yeah. Okay, so if you go back to the slides. Okay, so energy generation and storage, right? This one is mainly for their power walls, power roof, solar roofs, and also their mega packs. So basically, this one is to generate solar energy, to convert solar energy to electricity for houses. And this one is basically putting a solar panel on your roof. And then this one is for storage of electricity used for solar power. Okay, so for solar energy, right, you need to have both storage and so-called converters to make it a more reliable source of energy. So Tesla does both. So although their contribution to revenue is not a lot, okay, their contribution to revenue as of 2022 was only 5%. I expect this to actually go up in the future. So in the future, right, most likely you will not see Tesla revenue coming just from their EVs, but more from their energy generation and storage. Okay, so why do I invest in Tesla? Okay, it's very simple. Okay, because if you look at Tesla, right, they are at the crossroads of two growing industries, EVs and solar energy and solar power. Okay, these two things, in my opinion, will continue to be growing into the future. So that is why I invest in Tesla, because they are at a unique crossroads of both these two growing sectors. And if you look at Tesla figures, right, their growth rate has been quite impressive, at 62% in terms of 5-year compounded annual growth rate. I mean, 5 and 6 years is quite close together. So if you see every year, right, their growth rate is a double-digit figure. Although 2023 numbers will be a bit lower due to the economic conditions, I still expect it to be a double-digit growth from 2022. Okay, if you look at profit-wise and gross margins, right, you can see that the gross margin for their automotives, which is like EVs, FSD, supercharger networks, and whatnots, it stands at a very impressive figure of 28.5%. If you compare across all automakers, right, there is this figure actually very high as compared to industry peers. Okay, and then even for the energy storage and generation, it's also at a quite okay number of 7.4% gross margins. Okay, so even if you look at financial strength wise or financial health wise, Tesla's ROE, which is return on equity, is very high, and also they have very low debt and they're also cash flow positive. Let me just bring back the financial statement again. Yes, ROI. Okay, you see ROI is a very impressive number of 28.2% as of 2022. And then if you compare it for the past 2 years, right, it's also at a healthy figure of 18.7%. So if you combine everything together, I expect ROE to actually continue to be in positive double digits, although it may be lower for 2023. And then growth-wise, it should continue in double-digit figure growth. Okay, let's move on. Okay, so what is our Tesla growth prospects going forward? Okay, as we all know, there are climate change mandates for countries nowadays. All of them are looking to actually reach climate zero. So with that, right, EVs and energy storage systems will come into play for countries to reach sustainability. So if Tesla is able to continue growing their EVs and solar panels and even battery packs, this will be a major growth driver for Tesla in the next 2 to 3 years. Okay. Okay, and for Tesla's EVs, right, their top selling 2 EVs are Model 3 and Model Y. So Model 3 is their basic sedan model. Then Y is the SUV version. So just last year, there was actually a revamped Model 3 that came into production in September 2023. And then Model Y will have a revamp in 2024, expected to be in production in the second quarter. So both of these revamped models, right, may also lead to an increase in selling price for Tesla. So ASP basically stands for average selling price. Okay, so for EV production wise, in 2023, Tesla actually closed some of its gigafactories for upgrades. So once upgrades are completed, the expectation is that EV production will actually increase per gigafactory. So upgrades done, production increase equals to possibly increase sales for Tesla. Okay, so FSD and Optimus, right? Optimus is their so-called robot bot. They call it humanoid robot. Okay, so FSD is full self-driving. This is their autopilot feature and also potentially a driverless car. Okay, so if these both have advancements in both of these fields, right, there will be increased revenue stream for Tesla, because if FSD is able to fully function as stated, there'll be more interest in people signing up for FSD with Tesla EVs. So all these are the growth drivers for Tesla in the next few years. Inhibitors wise, okay, so quite simply, if there's no EV demand, Tesla will suffer. And we have to know that EV itself, right, they are not cheap to begin with. So you don't expect people to change a car every year. So if the economy weakens in 2024, people will cut back on discretionary spending. So when they do that, right, they will be less likely to buy a new car. So less demand equals lesser sales. Lesser sales equals to lesser revenue for Tesla. Okay, price cuts. Okay, so in 2023, Tesla actually had quite a few price cuts to their Model 3 and Model Y. This is actually to undercut their competitors and gain market share. However, in the long run, right, price cuts are not sustainable in the long run, because there's only so much I can cut until. So if the price cut continues to be longer and there are more price cuts in 2024, the average selling price for Tesla will definitely drop. which also will affect Tesla's top and bottom line. Actually, we actually saw this effect in 2023 when actually Tesla top and bottom line suffered due to their price cuts for Model 3 and Model Y. Okay, so increased material cost, this one is quite common sense. Because EVs cost materials to make. So if materials cost increases due to supply chain issues, the average cost price for each vehicle will also increase, which means that margins wise will decrease for Tesla per EV that they produce and sell. Okay, for regulatory action wise, if you are not aware, let me just bring it up for you all. Okay, the DOJ, the US Justice Department, Department of Justice, actually issued subpoenas to Tesla in their ongoing probes for FSD. So this one is basically due to FSD, certain claims made by Tesla on their FSD software. So currently it's still not being resolved yet. And then, so we do not know what's the outcome of this regulatory probe. But if the worst comes to happen and Tesla is fined or there are other repercussions, this will definitely affect Tesla's brand value in the market. Okay, so beside regulatory actions from the DOJ, there's also certain problems with Tesla vehicles. So recently there was a recall for Tesla vehicles in China to actually fix some parts of their safety features. Okay, so if this happens mass market across the whole board, you can expect there'll be lesser interest in Tesla's EV, which will definitely affect their sales figures. Okay, but if you look at it as a whole, right? To me personally, as an investor of Tesla, I still feel that Tesla will have room to grow in 2024 and beyond. Especially if rate cuts happen in 2024, then and the market does not and the economy does not weaken, there could be more demand for EVs going forward. Okay, so that's all for my Tesla investment. Let's move on to my second largest investment, which is Nvidia. Okay, this is a very popular stock in 2023 due to the AI boom, but actually I purchased it way before that in 2021. Okay, so returns due date is a triple digit figure, 134%. And the average price per share is at $205. In terms of proportion wise, it contributes around 12.6% of my total investment portfolio. Okay, so if you're not sure what Nvidia does, this is their entire revenue segments. So you can see the data center, there's gaming, there's professional visualization, automotive, OEM, and others. Okay, so for data center, it's basically centered around cloud computing and AI. Then gaming is about their GPUs for both gaming and also cryptocurrency mining. Professional visualization is more towards industry players for them to create a virtual environment for their work and factory productions. Auto relates to automotive, which also relates to EVs and software for driverless vehicles. OEM and others is basically Nvidia's partnership with certain brands such as maybe HP or Lenovo to produce laptops or workstations that is based on Nvidia's graphics cards. Okay, moving forward. Okay, so why invest in Nvidia, right? So back then in 2021, their data center revenue was actually increasing year on year. So when I saw that, right, I realized that Nvidia for next 2 to 3 years, right, will form the backbone of cloud computing and also AI and machine learning. So that is where I went in to invest in Nvidia. So fast forward to now, that thesis was true lah. So they actually provide the backbone for high performance computing, which is basically AI, machine learning, cloud computing. Okay, so in terms of GPU space wise, right, Nvidia is the market leader in terms of technology and also speed, processors, and whatnots. If you look at all the benchmark testers, right, it clearly beats the likes of Intel, of AMD also. So in terms of financial margins, if you look at the figures, let me just bring it up. Nvidia, yes, Nvidia. Okay, you will see that. Let me just expand this. Expand some more. Okay, you will see that its ROE is a very healthy double-digit figures. So although it's been decreasing for the past 2 to 3 years, it's still a very healthy 25.6%. And then if you bring in AI, right, I expect 2023 figures to be way higher than this because the margins for GPUs for AI use cases is actually very wide. And financials wise, they're also quite healthy. You will see a very high current ratio. Their debt is also okay. 41.2% seems to be quite high, but then it's still within acceptable range. And cash flow wise, they are still positive. If you see operating free cash flow is increasing year on year, and then compounded annual growth rate for it is 27.5% for the past 5 years. Okay, so in terms of growth drivers for Nvidia in the next few years, okay, so AI will continue fueling the demand for GPUs. So as Nvidia remains a market leader for GPUs for AI use cases, more AI growth means there's more demand for Nvidia's GPUs, which lead to more sales and also more revenue and earnings for Nvidia. In terms of GPUs wise, right, Nvidia is shipping out its H200 GPUs in the second quarter of this year. So this is rumored to be way more powerful than its current H100 GPUs. And it's also a direct competitor for AMD's new bulk of AI GPUs. So these H100 GPUs, right, I expect it to cement Nvidia's position as market leader because I think it will outperform whatever AMD or Intel can offer. And not only AI, right? If you look at Nvidia's other segments, for example, just bring it back to their revenue segments, like for example, gaming or even automotive. These two are actually potential growth drivers for Nvidia in the next few years. Gaming wise, because of cryptocurrency, as we all know, is gaining traction. And if the Bitcoin ETF gets approved next week, expect more demand for crypto, and also which also leads to more people opting to have mining equipment, which also means more usage of Nvidia's GPUs. So automotive, to me, is a possible growth driver, because if there's an advancement in if there's advancement in driverless vehicles, then you will see that Nvidia's GPUs will also be in a huge demand. Okay, in terms of inhibitors to growth, as we all know, there's export restrictions for Nvidia's AI GPUs to China. And then because of that, they are losing market share to companies like Huawei. If you look at the news recently, actually Baidu, right, actually purchased a bulk of Huawei's AI GPUs. But of course, Nvidia also has new models that comply with restrictions. So, but we do not know how powerful they are as compared to native AI GPUs that are made in China. So, as I mentioned before, there's also increased competition from AMD and also Nvidia's biggest customers in both Amazon and Microsoft. So, both Amazon and Microsoft, they're actually coming out with their own AI chips to actually not be so reliant on Nvidia's AI GPUs. So this could be a potential hit to Nvidia's top line. But then both Amazon and Microsoft, right, they already come out and say that they will still remain significant customers of Nvidia's GPUs. So I do not foresee a big issue here, but we never know. So it's good to actually look at Nvidia's financial results in the next few quarters. Okay, so as we all know, right, demand for GPUs is very high right now. And then due to certain supply chain issues, there are supply shortages of Nvidia GPUs. So if this persists, right, and then competitors come up with new models, customers might turn to competitors instead because they don't want to wait that long for Nvidia GPUs, although they can be more powerful than other competitors. Customers want to have the ready access to AI GPUs as quick as possible so they can implement in their own company structures and whatnots. So if supply chain issues persist, then Nvidia might lose customers to its competitors. Okay, so moving on to my third biggest investment. So this one is a Singapore REIT, which is quite prominent, which is Ascendas REIT. So it contributes about 13.5% of my investment portfolio. And returns wise is about 13%. So this 13%, right, includes both capital gains and also dividends received since 2021. Yeah, because for REITs wise, most of the time, their capital appreciation is not that high. Most of the returns will come from the dividends that are given out. So average cost price, as you can see, is $2.86. And then, yeah, around about 10,200 shares of Ascendas REIT. Okay, so if you don't know what Ascendas REIT is all about, they have there are three main property segments: business and science parks, industrial and data center, and also logistics centers. This includes your warehouses, cold storage, and whatnots. Okay, in terms of percentage wise, their biggest contributor comes from their business space and life size, followed by industrial and then logistics. Geographical wise, most of it comes from Singapore, and then you have properties in Australia, UK, and also the US. Okay, so for my investment thesis behind Ascendas REIT is that they are one of the biggest industrial estate on the market. If I'm not wrong, they are the biggest, if I don't recall wrongly. Yeah. So when it comes to REITs, right, your sponsor, your size matters because it determines how many properties you can acquire and at what price, and also whether the price will be attractive or not. So if you invest in REITs as smaller sponsors or smaller in size, right, their pool of potential properties is just not that wide in a sense. Yeah, so if possible, invest in bigger REITs so that they have more opportunities for property acquisitions. So in terms of financial metrics, growth and dividend yield, Ascendas REIT also has quite attractive yields and good financials. If you look at financial wise, okay, their gearing ratio as of this is 2022. So I'll try to find let me see whether I have. Okay, yeah, I have the third quarter recent quarter. Okay, so if you see where is their financials? Okay, balance sheet wise, their leverage ratio is not very high. It's only at 37.2%. And in terms of interest coverage ratio, it's a healthy 4 times. Adjusted interest coverage ratio is at 3.8 times. And then, yeah. Let me see whether I got any other financial metrics down here. Debt cost. Is there a debt cost here? Where's the debt cost? Oh, okay. Debt cost at 3.3%. which is not say very low, but not say very high also. It's somewhere in the middle. And in terms of debt tenure, it's at 3.3 years. Maturity profile-wise, it's also quite well spread out over the next few years. There's no 1 year when a huge sum of its debt is being refinanced. Okay, let me go back. Okay, so in terms of revenue sources, right, as I shared earlier on, Ascendas REIT revenue comes mainly from Singapore, but also a portion of it comes from Australia, UK, and the US. So, so in my own opinion, in my own personal take for REITs, right, I don't normally invest in REITs that have their revenue mainly from one country. So, for example, if it's 100% in Singapore, normally I'll skip that REIT. The reason behind it is that you want to diversify. To me, I would rather diversify. I would rather have a REIT that revenue is well diversified between all countries as compared to one that is just fully concentrated in Singapore. Okay, so in terms of tenants for Ascendas REIT, most of it are in the health science, life science, and logistics portion. Let me just break it down. Where is it? Where is it? This market outlook. Yeah, as you can see, most of their tenants are in growing industries like data centers, logistics, ICT, and also biomedical sciences. So all these are actually growing sectors for the next few years. Okay, moving on. So in terms of growth drivers for Ascendas REIT, right? As you all know, REITs are actually sensitive to interest rates. So if there's a rate cut in 2024, it will be a boom for REITs lah. Prediction for rate cuts is happening in 2024, just a matter of when it will happen. But for that, no one really knows when it will happen lah. But just be aware. Further growth in tenant industries for Ascendas REIT will actually have more rental income for Ascendas REIT because they can actually increase the rents of tenants that are in growing industries and sectors. Okay, so as covered earlier, where is this? Okay, so as you can see, logistics-wise, right, it contributes 12.5% of Ascendas REIT's total revenue. Okay, so it's actually, so if you look at Singapore itself, right, Singapore is a supply chain hub, it's a shipping hub, it's a logistics hub. So that is why you see major improvements in Changi Airport to have more terminals, and also major improvement in Tuas Port to actually bring in more, to actually handle more ship cargo, more shipping volume. Okay, so all this already contributes to, can potentially contribute to more logistics revenue coming for Ascendas REIT. So in terms of inhibitors wise, if there's a slowdown in the economy, then it will affect Ascendas REIT because they are actually sectors are actually, so if all those if economy turn bad, right, all these sectors will be affected quite significantly, except maybe for data centers lah, because this one, no matter what, more or less you will still need it around. But then in terms of engineering, in terms of ICT, in terms of biomedical sciences, all this will be affected if the economy takes a downturn in 2024. Okay, so as if the rate cuts don't happen that frequently or that early in 2024, that will also impact the potential price appreciation for Ascendas REIT. Okay, moving on to my fourth investment. Okay, Keppel DC REIT. It contributes 14.6% of my investment portfolio, and year to date it's a negative return if you include dividends. It's a negative return of 11.38%. The average cost price wise is $2.25. Okay. Okay, so if you don't know Keppel DC REIT, they mainly invest in data centers, and their data centers actually have a few segments. Let me just bring this up. Okay, so the data centers are actually categorized into co-location, fully fitted, and shell and core. So fully fitted means that the equipment is all there already. It's a fully equipped data center with all the server racks and whatnots. So all these fully fitted data centers, right, are normally leased out to one or two clients at most, one or two big clients. Those smaller clients or smaller SMEs, right, they'll go for co-location data centers. This one is where they actually share with other companies and other firms. So in terms of proportion wise, co-location data centers contribute the most to Keppel DC REIT's revenue, and then followed by fully fitted, and then shell and core. Okay, so why did I invest in Keppel DC REIT? Okay, so as we all know, data centers are actually crucial infrastructure moving forward, be it in AI, be it in cloud computing, e-commerce, all these technological advances or advancements, you need data centers as a backbone to provide the necessary bandwidth or necessary network infrastructures. So yeah, that's one of the main reasons why I invested in data center REIT. So in terms of financial wise, for the past few years, Keppel DC REIT has been performing quite alright. If you look at its gearing ratio, it's been quite low at 30% and then let me just compare it to its latest third quarter results. Okay. Okay, so debt wise, 0.2% aggregate leverage. Debt cost remains quite same as normal industry peers at about 3% plus. And then also its ICR is at 5.4 times, which is quite alright. And then debt tenure wise, 3 years, so quite alright. So financially speaking, in terms of financial health wise, Keppel DC REIT is doing quite okay. Okay, so in terms of revenue source, in terms of geographically speaking, right, most of Keppel DC REIT's revenue comes from Singapore at 53.2%, followed by, if I'm not wrong, followed by Ireland, and then Australia and China. Yeah, so you can see that most of the revenue is quite well diversified. The majority coming from Singapore at 53%. I think come 2023, this should drop a bit, but we shall see. Okay, so data center wise, right, compared to other properties like industrial properties or even office buildings or retail malls, their client lease are actually much longer. So if you have longer leases, it means that there is more stability in your rental income. So that's also why I actually opted to go and invest in Keppel DC REIT. If you look at their lease expiry profile, do I have it here or is it in the third quarter one? Lease. Okay, see their portfolio weighted average lease expiry is really quite high at 7.8 years. This is due to the data center leases being very long in general because you need to have, because most companies that use data centers, they want to have a longer lease so that their network is stable and then there are no disruptions to their networks and business operations. Okay, moving on. So in terms of growth prospects of Keppel DC REIT, Once again, rate cuts will bring a boom to REITs, no matter which REIT you're looking at. Okay, then in terms of AI growth, cloud computing will also drive demand for their data centers. This is in addition to limited supply of new data centers, be it in US, Singapore, or other countries. Okay, the reason why there's limited supply, right, is because when data center comes into a power grid, it has to ensure that there is enough space in the power grid to actually sustain the data center operations. So the grid is already used or fully utilized, right? There's very little room for a new data center to come in and also tap on the electricity grid. Wait, let me drink some water first. So yeah, so there's lesser demand, lesser supply. There's lesser supply but increased demand. It only mean that clients and customers will go towards Keppel DC REIT, which already have existing data centers, to actually rent from them. So this will create a boom to Keppel DC's rental income. Okay, inhibitors wise, expected once again lesser rate cuts means that the appreciation for REITs prices will be lower. Okay, so this major tenant bankruptcy, this one is based on their. Let me bring up that article. Where is their okay? So this one is based on their tenant, their second largest tenant, which is this telecom company. Although they don't never review it, right? It's actually a company in China, which is Neo Telemedia. So they actually Neo Telemedia, right? They didn't provide rental payments since October last year. So it's been about 3 months. Then Keppel DC also issued a letter of demand to this particular tenant to ask them to actually pay up their rental that they didn't pay and also increase their rental deposit. So if this tenant goes bankrupt, right, there will be a 7.8% hit to Keppel DC's REIT gross revenue, which is quite substantial. So as of now, we do not know what's the outcome for this. So it's still being a limbo. But once its Q4 results come out, right, there will also be a major hit to its DPU. So if you look at the quarter DPU, right, of 2.492, expect it to drop drastically to about maybe even 2.2 or 2.1 because the tenant has not been paying since October. Since Q3 ends in September, it means the whole of Q4, this particular tenant, has not been contributing to Keppel DC's REIT rental revenue, which will also bring a huge downside to its DPU. So there's a possibility that come Q4 results release, this number will drop drastically. So if it drops drastically, right, expect a huge market price decrease also. So that's one risk of investing Keppel DC REIT right now. Okay, so for data centers as a whole, they are actually run on very high utilities costs. So if electricity goes up, if water prices go up, the cost of running data centers will actually also go up, which means that there will be lesser profit for each data center that Keppel DC REIT holds, which will once again affect our DPU. So capex wise, okay, because all countries are going towards climate zero, right? They might have old data centers that may not meet certain climate standards. So let's say, for example, if they are not in line with certain targets or percentages, right? Keppel DC has to actually go into the data center and spend a huge amount of money to actually so-called upgrade it to meet these climate standards. Okay, so if they're going to do that, right, it means there will be more money to be set aside for capex, which will once again might affect the debt ratio for Keppel DC REIT, also possibly eat into the DPU payout. So last but not least, higher carbon tax. As we all know, let me see where is that article. Okay, Singapore actually will be increasing its carbon tax for 2024 and 2025. So for 2024, it's at $25 per ton, up from $5 per ton of last year. And then for 2026 onwards, it'll be $45 per ton. So if Keppel DC REIT data centers are not able to meet certain climate targets, they will be hit by this higher carbon tax, which will once again increase the operating costs, which will then also affect your DPU payout. So for me, if I were a new investor, normally I won't invest in Keppel DC REIT right now, at least not at its current price of about $1.84, if I'm not wrong. But for it to, if you ask me, right, for it to drop until maybe $1.60, yeah, then you may invest in it. But in the long run, it should still do well because of all these growth drivers, like your AI, like your cloud computing also. Okay, so moving on to the next investment. Okay, my next one will be ParkwayLife REIT. This one contributes 14.2% of an investment portfolio, and then total returns wise, including dividends, it's at negative 7.29% since 2022, since 2020, which is about 3 years. So average cost price for each share is at $4.15. Okay, so ParkwayLife REIT, right? They actually own nursing homes and hospitals, private hospitals in Singapore. So hospital in Singapore, and then nursing home in Japan. Yeah, they have no nursing home in Singapore as of now. So percentage wise, for ParkwayLife REIT, let me just show you all. Majority of their revenue comes from their hospitals, which is the Mount Elizabeth, Parkway East, I think. Is it called Parkway East Hospital? Yeah, basically, yeah, Parkway East, yes, Parkway East Hospital, Mount Elizabeth, and Gleneagles. Okay, so why did I invest in ParkwayLife? Okay, so ParkwayLife REIT, right, is my defensive investment in your entire portfolio. Like for me, you see me investing in Tesla, Nvidia, and whatnot, right? Those are your growth stocks. And then Keppel DC REIT, Ascendas REITs are sort of your stable-ish, growth-ish type of REIT. But ParkwayLife REIT itself, right, is defensive in nature because it's in the hospital scene. So hospital, nursing home, even if economy goes down, right, people still have to go to hospitals if they need surgeries. And then nursing homes, you don't expect old people to, all of a sudden, like nursing home closed down because economy not being good, right? So this one is no matter what happens with the economy, good or bad, it should still be rather stable and also do well. So in terms of financial metrics, if you look at ParkwayLife REIT, gearing ratio is at 36%, which is quite impressive, quite normal, quite healthy ratio. Average debt cost wise, wait, let me just show you all the third quarter one, easier. Okay, so average debt cost wise at 1.32%, which is quite low as compared to other REITs because most of their debt is in Japan. So Japan, as of now, because of the monetary policy, the interest rate is not very high. See, it's a negative interest rate. So that is why their debt cost is quite low. So interest coverage ratio wise is at 12.8 times, which is really high for a REIT. I think one of the highest in the entire S-REIT market. And then gearing is at 36%, which is quite healthy. So overall, it's a very stable REIT with stable payouts. But then capital appreciation wise, it's not there as of now. So you have to wait a while. And then once again, naturally long leases also offer income stability. So hospital, nursing homes, their leases are actually very long. If you look at ParkwayLife REIT, their bill is, I think, double digit figures. Let me just double check. Bill with the average lease expiry. Yes, 16.5 years with the average lease expiry. Okay. So in terms of growth drivers and inhibitors for ParkwayLife REIT, okay, as you all know, modern society, we are all facing aging populations. Like for example, be it Singapore, be it Japan, our birth rate is not very high. So sooner or later, there'll be more old people than young people in the population. So if this happens, right, then there'll be more, put it in a very bad way, there'll be more visits to hospitals and nursing homes, which will actually positively influence ParkwayLife REIT's earnings and revenue. Okay, this project Renaissance, right, is a project, it's an ongoing project for the Mount E Hospital. It's to actually revitalize and refurbish the hospital across the next 3 years. So it's a so-called joint project with the REIT and its sponsor. And then over the next 3 years, ParkwayLife REIT will be paying 50 million for capex works. And then once the thing is done, right, there will be expected to be more revenue for Mount E Hospital, which also provides more revenue to ParkwayLife REIT. Okay, so inhibitors wise, okay, so as I mentioned before, the why ParkwayLife REIT debt cost is so low, right? Because of their majority of their loans is in Japan. So currently Japan's interest rate is negative. So that is why they can enjoy a very healthy type of debt costs. But once BOJ switched their monetary policy stance to a more not so relaxed policy, then the interest rate will creep up. So if interest rate for Japan creeps up, means that interest debt costs for ParkwayLife REIT will also increase. But then this for now, BOJ's stance is that they will still maintain their negative interest rate and then will reassess it coming soon in 2024. And then of course, if Project Renaissance incur additional costs, then ParkwayLife also has to pay out more capex costs for next 3 years until it's completed in 2026. Yeah. Okay, so my second last investment counter is Lendlease REIT. It's contribute around 8%, 8.7% of my investment portfolio. And then I actually invested in it since the IPO in 2019, then sold it in 2020, and then bought it back in 2022 until now lah. So this returns you see here of negative 1%, right, is since 2022. I did not include the returns I had in 2019. So yeah, average price for it is currently at 68 cents lah. Okay. So Lendlease REIT actually has shopping malls and office buildings. The shopping malls is two very prominent ones in Singapore. 313 at Somerset, and then Gem at Jurong East. Office building wise, they own an office building complex in Italy, Milan, and then office building also in Singapore. The office building of Gem, which is leased to M&D for 12 years. Okay, so back then why I invested in Lendlease REIT, right, was because I saw that their dividend yield was quite high. If I don't recall wrongly, the IPO with dividend yield of 7.65%. And then my initial analysis was that the financial matrix was quite alright. So that's why I invested in it when it IPO. I also bought it back in 2022. Yeah. So another aspect to Lendlease REIT, right, is that they have a very long lease for their office building tenants. If you look at its latest results, let me just bring this up. Let's bring this here. Okay, you'll see that bill is at 5.3 years. This is due to a long lease for the Sky Complex in Milan. Due to the Milan Sky Complex, and also the M&D building is leased until 2044, which is 20 odd years. So these two buildings actually contributed to their high weighted lease expiry. Okay, so for shopping mall wise, right, then this actually their occupancy is actually quite healthy, which is very good. You will see the occupancy wise for 313 and Gem being 100%, and then 313 being a prime retail mall in Orchard, right? 98.9% actually is a very healthy occupancy number. So this there's no worries for the occupancy side wise. It's more towards the financial health of the REIT itself. Okay, but as I mentioned earlier, I'll be starting it off soon. As long as they manage to hit 65 cents, I will sell it off. So reason for selling it off, right, is due to I do not see a good prospect for Lendlease REIT. So why do I say so, right? Because okay, first of all, if you look at their Q1 results for FY 2024, right? Where is their okay. Their gearing ratio is very high at 40.6%. But this one is excluding their perpetual securities, which is about 400 million. So if you add that in, right, they will actually breach the 50% gearing limit. You'll come up with a number of, I think, 51.6%, if I'm not wrong. So secondly, if you look at their interest coverage ratio, although it looks very healthy at 3.9 times, right, their adjusted ICR, which takes into account their perpetual securities, is only at, where is it? 1.9 times, which is actually quite poor because if you look at Ascendas REIT earlier on, their adjusted ICR was 3.3 times. So 1.9 times actually is borderline quite scary if you ask me. Yeah, so that is why I'm planning to sell it off soon at about 65 cents. Okay, so but if you're holding on to Lendlease REIT, right, I'll just share with you all what I feel it could be its growth drivers and also its inhibitors. So once again, rate cuts quite obvious. Okay, so recently Lendlease REIT actually restructured their lease agreement with Sky Complex. So if you see their announcement, where can you all see this? I think I'll just zoom inside more. Okay, so Sky Complex, right, consists of building 1, 2, and 3. Okay, so originally before this restructure of this agreement, right, Sky Complex, Sky Italy, which is the tenant, owns all 3 buildings 1, 2, and 3. But since the restructured deal, you only be owning 1 and 2. Building 3 will be returned to Lendlease REIT in the first quarter of this year. So should be by March. By March. So this is okay. So to me, right, this is quite good news for Lendlease REIT because it allows them to actually re-let the place out to other tenants, and that in turn will bring a potentially higher rental as compared to just leaving it with Sky earlier. So if they're able to lend it, if they're able to lease it out to prospective tenants, then it could be they could provide potential upside to their rental income. Okay. And then besides that, right, there's also the multi-functional space beside 313 as someone said. So this event space, right, is scheduled to be completed in 2025, which is next year. So as of now, construction has not started yet, but then it will start. So according to the CEO during the AGM, right, he mentioned that it will start soon, but don't know how soon is soon. He actually mentioned end of 2023, but then if you go to the place now and see, right, it's still quite empty. So I don't know when it will start constructing, but once it start construction, right, expect it to take up about 1 year to actually be completed. So you only see revenue upside after 1 year. Okay, so inhibitors wise, there's actually quite a lot. Actually quite a bit, quite significant bits. Okay, so as I mentioned earlier, building should be given back to Lendlease REIT in Milan. But let's say if the office demand in Milan is not strong, there's a possibility that Lendlease REIT may have issues leasing out that property. So the property might have a low occupancy rate. But this is all depending on the economy for demand from Milan side. Okay, so besides the prospective low demand for office space in Milan, there's also a consideration for both the debt refinancing and reset of the perps in FY 2025. Okay, if you see the latest results, where is it? Latest results. Okay, you will see that 2025, right, is close to about 400 million to be refinanced in FY 2025. So FY 2025 runs from June 2024 to June 2025. And then if you look at the first reset date for the perps, it's actually at, let me see, where is it? Okay, if you look at the perps reset rate, right, the first reset is at 11 April 2025, which is at the tail end of FY 2025, which also means that they refinanced close to about 400 million, plus redeem back their perps of 200 million. So let's say they all don't redeem back, right? Their perps rate will rise to the prevailing interest rate plus 3.043%, which will most likely be higher than their original rate of 5.25%. So come FY 2025, right, Lendlease REIT will have a potential issue in terms of meeting these two requirements. So one way for them to actually do this is to actually redeem back the perps and then issue new perps. Or the worst case scenario is they issue a rights. They issue new shares to redeem back or to refinance the debt. As of now, I do not know what option they will take, but then if the gearing ratio remains as such, at 40+%, right, there's a very high chance that you're looking at a rights issue to redeem both, to refinance both the debt and also redeem the perps. So that's one thing to look out for in FY 2025. Okay, the last counter will be SGX, also known as Singapore Exchange. So it covers 7% of my portfolio, and then returns wise, including dividends, is at 3.76%. So invested since 2021 at an average cost price till date of about $10. Okay, so SGX wise, their revenue is as such in fixed income, currencies, and commodities, and also equities, and indices, and data and connectivity. So for these two sectors, equities, fixed income, currencies, commodities, right, it's mainly down to derivatives. Okay, let me just open up the data for you all to see. Okay, if you look at SGX revenue statement, let's see whether it's it. Yeah, okay. You will see that a majority of it comes from equities, but it's not your standard equities in terms of IPOs or listings. It's more towards derivatives because that's their main revenue driver as of now. It's no longer about listing IPOs or whatnot already. It's all about derivatives in terms of currencies, FX, commodities, and equities. So derivatives are basically market instruments, like for example, futures, options, and whatnots. Okay, so that one is more on the more advanced side. But just know that their main revenue contributor is all towards derivatives. Okay, so why invest in SGX, right? Because SGX itself is a fee-based business. This means that as long as you trade Singapore stocks, be it stocks, REITs, or whatsoever, or even ETF, SGX has a small cut from a trading fee. So be it you invest in you invest in Tiger Brokers, Mumu, Poems, or whatnots, as long as you trade SGX counters, SGX will have a fee from it. Okay? And then in terms of dividends payout, it's quite stable over the past few years. If you see its dividend payout, it's about 32.5 cents as of 2023. I think if I'm not wrong, it increased to 32.8 cents for the previous FY, for the last FY. So yeah, if you see for the past 6 years, it's been increasing at a rate of 2.5%. Not great, but yeah, stable dividend payouts. So in terms of growth, right, I expect further growth in derivatives. So derivatives in terms of currencies and commodities. Equities side, I don't foresee a big growth in there. But then it could also increase due to increased market trading, but you never know. But much of it I think will come from their commodities and currencies. Okay, so growth drivers for SGX, as I mentioned before, increased derivative offerings, more trading means more fees that SGX can collect. And then, okay, so SGX, right, to grow SGX, right, they're looking at partnerships with other stock exchanges. So recently, last year, we saw the Thailand, what do you call it? What's the particular term? I forgot the term. Basically, they have a partnership with Thailand to actually list some of their stocks on SGX and also list some of Singapore stocks on the Thailand exchange. So IPOs wise, so for the IPOs, right, during the AGM, SGX mentioned that they expect IPOs to come in 2024 if the market remains, if the economy remains healthy. And then in terms of climate and sustainability linked market instruments, there's a demand for this with the climate change, all those targets coming in, there'll be increased demands for listing of such indices or ETFs on SGX. Okay, so inhibitors wise, simple. So lesser trade in derivatives means lesser fees. Okay, so as mentioned earlier, right, as long as there's a trading of SGX counters, means that SGX has a fee. But then let's say if there's decreased interest in trading in S-REITs, there'll be lesser fees that SGX can collect. So means that lesser revenue for SGX. And then there might also be black swan events that might affect market confidence in Singapore market or global market. This one can be unforeseen global events like, for example, another war or certain conflicts which may cause a market downturn. Or if the economy goes into recession, it might also cause a market correction. So all this can also impact trading activities on SGX. Okay, so if you take everything as a whole, portfolio value wise for US is actually quite alright, returns of about 49%. And then the Singapore portfolio is a negative return of 8.7%. For this one, I'm not too concerned because it's actually excludes dividends. So if you include dividend, I think it'll be a positive number. Yeah, so moreover, most of the counters I have, I plan to hold them for long term, except for Lendlease REIT. So there's still time for them to recover and become positive. Yep. Okay. So last but not least, okay, goals for 2024. I got just 4 main goals, not so much. So basically, in terms of content creation, I plan to go into possibly exploring different content formats of different content ideas. And also and also of course, the goal for this year is to get monetized on YouTube. Okay, and so in terms of trading, because nowadays, right, I trade options quite regularly. So I want it to actually become a more regular income source. So I'm looking to trade more options and becoming better at it in 2024. And last but not least, also diversify my investment portfolio. This one, it means that I'm looking at investing in certain counters that in certain industries or sectors. For example, I'm looking at possibly investing in Visa or MasterCard to get into the payment sector, and also possibly invest in a consumer staple stock. Although I don't know what's that as of now. So yeah, I will go and explore and see and do some research and see which one is good to invest in. Yeah, so that's all for the first live. It took about an hour plus. So yeah, let me just go through some of the comments. Oh yeah, if you see replies in the comment section, right? But it's not me typing it because this channel is owned by 2%. Myself and one of my friend. So he's a silent partner lah. So do not be surprised why there's a reply in the chat, although I'm speaking out here. Okay, so let me just go through some of the comments. Okay, yes, actually this is very strong. Income received in foreign currencies could be volatile. Yep, correct. Yeah, yes, correct. Because when you receive foreign currency in Singapore dollars, naturally, the value will go down because the SGD currency is strong. But then if let's say if the opposite foreign currency is, let's say a stronger currency like USD or Euro, you could actually see a potential increase in terms of rental income. But that is why, right, most REITs will actually hedge their foreign currency to make it less volatile in nature. Elvin Alexo TV, new to investing, studying how to get into it, would you recommend starting now or wait for the first dip? Alexo, okay, invest now or wait for the first dip. I think it depends on what you're investing in. If you're investing in ETF, there's really not a good time to. I mean, you can just start now and slowly DCA. But if you ask me, I will still prefer investing in a dip lah. Yeah, but that's just a personal opinion. But then yeah. But if I was not investing for long term lah, so if you buy now or buy later, if you buy ETF, it may not really impact much. But if you buy individual counters, then your entry price is quite important, and then it's best to buy it on the dip instead of just DCA all the way. But if you buy ETF, it doesn't really matter lah, because ETF, their price appreciation is not that high. So user, do you enter the data or number yourself? Yes, I do. The Excel, you see all the Excels, right? It's just data from the annual reports, financial statements and whatnots. So yeah, all these things are inputted by myself. Yeah. I mean, it may look like a lot of things to do, but once you get into the flow, once you do it quite frequently, it's not that difficult. It's just about inputting numbers in when the new report comes in. So yeah. Okay, yeah, I think that will be all. I'll be ending my live now. So thank you for viewing if you're still here. So yeah, look forward to the next live. Most likely could be next Friday. I will update again in the community tab. But yeah, should be next Friday lah. I will chat about maybe crypto or the Bitcoin ETF. So yeah, thank you for joining today. See you all